Hello and thanks for joining us today for the Investor Outlook web chat with Lloyds TSB Wealth Management. Now, I know a lot of you have been sending over your investment questions for discussion during today's session, and we will come on to those in just a minute. But in the meantime, I wanted to introduce our investment expert, who is Nick Hodson, Head of Investment Policy at Lloyds TSB Wealth Management. Hi, Nick.
Hi there.
Thanks for joining us, Nick. Now, obviously, you are a financial expert, particularly in terms of the stock market and investment. And you've been looking at the changing ways that we have been investing in these stock markets.
That's right. It's important for us to be able to gauge just how investors are feeling, gauge their sentiment. And to that end, we've had our third survey of investor opinions just published out very recently, and we've learned a great deal of things about what's happening with investor sentiment right now.
A lot of changes. What exactly have you been finding?
Well, one of the primary parts of the research suggests that the average amount that the investors that we asked have put to work into the stock market has halved from around £50,000 this time last year to around £25,000 right now.
And that is a massive reduction.
It is. It's a huge shortfall from where we saw it this time last year. But really we asked ourselves, where has this come from? And I think the answer is twofold. First of all, it's the FTSE 100 has in itself fallen by around 30% since this time last year. But I think really what we've seen is around a quarter of the investors that we talked to have moved their money away from the stock market and into less risky areas, such as bonds and cash.
So you're saying that people are actually changing the way that they're investing as a result of their fears regarding safety in terms of the market?
Well, I think this is probably one of the more surprising things that we came out of the survey, was that these investors who've moved their money away from equities and into less risky areas such as cash and bonds have done so without seeking professional advice. They're doing it based upon their emotional decisions and based upon some of the information that they're seeing out there in the media.
So they're acting out of fear as opposed to fact.
I think that's what we're finding in the vast majority. Of course, there are some people seeking professional advice, and that's clearly what we'd advise them to do.
Well, that's exactly what you're here for. Let's get on with the questions, and many of them that we have in from our viewers. Let's start with Simon Bowden from Swansea, who asks Nick, how can I protect myself going forward from another stock market crash?
Well, Simon, I think really the only way to protect yourself is don't get invested in the stock market in the first place. That is the one true way to make sure that you are fully protected. However, there are a number of different products out there which enable you to benefit from the upside of the stock market, but protect your downside. One of these particular products called an MLD, or a market linked deposit. So I would advise, go along, see a financial advisor, ask about an MLD and see whether it's suitable for you.
But basically, Simon, if you're worried, don't go there. OK, thanks very much indeed. Mark Fiender from Leeds is due to retire in 10 years. So he says, what steps should I take to protect my pension investment from stock market volatility?
Well, first of all, have a look at your entire portfolio. And that might mean, again, going to talk to somebody who can assess that on a rational basis and give you a good 10-year plan. Now, if you're 100% invested in the stock market at the moment with 10 years to go, I would expect that your advisor might suggest a little bit more diversification into other asset classes.
Simon W. from Norfolk, he says, what about corporate bonds? What are they, and should I be investing in them?
Well, Simon, I don't know whether you should personally be investing in them. You should go and talk to somebody who will advise you on that and to check out your entire financial plan. But corporate bonds, much like gilts or government bonds, are IOUs issued by corporates, though, not the government. So you might find those kind of corporations issuing these bonds, well-known names like Marks & Spencer, Tesco, Shell or BP.
Nick, thanks very much indeed. It's been a very interesting, fascinating session. Thanks for all your advice and guidance. Before we let you go, I've just got to ask you for your top 3 tips for 2009 for investors and budding investors out there.
I think first of all, don't make any knee-jerk reactions. Make sure you seek professional, informed advice before you make any key decisions in the investment arena. The second point is make sure that any plan that you have put in place is absolutely bespoke to your needs. Consider your risks, consider the rewards that you require, and make sure that the plan addresses those key areas of concern. And perhaps lastly, make sure that you consider your investment horizon as well. So it's no good trying to push all of your money into the equity markets, for instance, for a very, very short time. Make sure that you diversify across all the different asset classes, and that way you might keep yourself from not being able to sleep in the evenings.
Okay, Nick Hodson, thanks very much indeed, Head of Investment Policy at Lloyds TSB Wealth Management. And of course, to all of you for all your questions and comments. We'll see you next time.